There's a lot of debate about the past 3 years of high inflation and the impact on American families. And now that inflation is receding, there's been a great deal of speculation about when the Fed would cut rates. What say you?
So what we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%.
Welcome back, everyone, to another insightful discussion on economic trends and policies. Today, we're delving into the intricate world of interest rates and inflation. These two factors play a pivotal role in shaping the economic landscape, and understanding their dynamics is crucial for both investors and everyday citizens. So let's dive right in. Unveiling the federal funds rate. At the heart of monetary policy lies the Federal Reserve's control over the federal funds rate. This interest rate serves as a lever, allowing the Fed to either stimulate or cool down the economy. When the Fed adjusts the federal funds rate, it ripples through various sectors, affecting everything from mortgages to business loans. An increase in interest rates makes borrowing more expensive, thus putting the brakes on economic growth. Conversely, a decrease in rates encourages borrowing and spending, stimulating economic activity. Impact of interest rates on borrowing and spending. Variable rate mortgages, new fixed-rate mortgages, and business loans are among the financial instruments directly impacted by changes in interest rates. As borrowing costs rise, businesses may pull back on investments, leading to higher unemployment rates and a slowdown in economic expansion. However, the Fed's primary goal isn't to stifle growth, but to maintain stability, especially when economic prosperity threatens to fuel inflation. The inflation conundrum. Inflation, the persistent rise in prices, is a double-edged sword. While a healthy level of inflation indicates a growing economy, excessive inflation erodes purchasing power and disrupts economic equilibrium. The Federal Reserve targets an inflation rate around 2%, aiming to strike a balance between economic growth and price stability. Addressing post-pandemic economic challenges. The COVID-19 pandemic brought unprecedented challenges, prompting central banks worldwide to adopt unconventional monetary policies. In the United States, interest rates plummeted to near-zero levels, accompanied by extensive monetary stimulus measures. While these actions provided short-term relief, they also fueled concerns about inflationary pressures down the line. Analyzing current economic trends. Recent inflation data reveals a concerning trend, with inflation rates surpassing the Fed's target. Despite efforts to rein in inflation by raising interest rates, inflation remains stubbornly high. Core inflation, which excludes volatile food and energy prices, paints an even bleaker picture, hovering around 3.8%. Month-over-month inflation data shows a worrying uptrend, indicating that inflationary pressures persist. Lessons from history. A glance at past economic crises, notably the inflationary woes of the 1970s, serves as a cautionary tale. Premature easing of monetary policy led to prolonged periods of high inflation and economic instability. The Federal Reserve is keenly aware of these historical pitfalls, emphasizing the need for prudent policy decisions to avert a similar fate. Navigating uncertain terrain. While the Federal Reserve has signaled intentions to lower interest rates, in 2024, caution is warranted. Political pressures and the lingering threat of inflation complicate the path forward. Investors and policymakers alike must remain vigilant, considering the broader economic implications of policy decisions. Conclusion. As we navigate the complexities of interest rates and inflation, one thing remains clear: economic stability requires a delicate balance. While the Federal Reserve aims to steer the economy towards sustainable growth, challenges persist on the horizon. By understanding the interplay between interest rates, inflation, and broader economic trends, we can better prepare for the road ahead. Thank you for joining me on this enlightening journey, and until next time, stay informed and stay curious.